Hello and welcome to Moneylife News and Views. I'm Debashis Basu. America's stock market, unconcerned by the trade tensions or fiscal strain, sits near a record high. The exuberance is driven by a new generation of techno optimism, this time about artificial intelligence. The Magnificent Seven, that's Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, now account for roughly 38% of S&P 500's market capitalization and about half of its profits. Their dominance and the feverish faith evoke the new technological revolution evokes memories of the late 1990s dotcom mania. The S&P cyclically adjusted price earnings ratio has breached 40 for the first time since 2000, when it reached 44 shortly before the benchmark plunged by nearly half as the internet bubble imploded. Then, as now, the conviction that a digital revolution would rewrite the rules of the game justified almost any valuation. Then, as now, the danger is that when the music stops, the fall will be sudden, faster, and deeper than anyone expects. Writing for The Economist magazine, Geeta Gopinath, till recently the first deputy managing director of the IMF, calculates that a dot-com-like market crash would wipe out over 2 trillion in wealth for American households, equivalent to roughly 70% of American GDP in 2024. The global fallout would be wealth losses exceeding 15 trillion, or about 20% of the rest of the world's GDP. Her argument has sent investors into an uneasy debate. There are calls, questions all over the place in social media. What this means, there's a lot of scare all around. Unfortunately, Ms. Gopinath skips over the likely causes behind the possible crash, and she goes on to focus on how a crisis this time cannot be cushioned by a resilient dollar or a government-led rescue through tax cuts or spending splurges, something that happened in the previous 2 crashes. Washington's toolkit looks empty this time. So, is a dot-com-like crash likely, and why? The likeliest sources of trouble lie in 4 corners of the financial system: incestuous investment loops within the AI ecosystem, the ballooning, barely regulated private credit market, soaring public sovereign debt, and speculative froth in cryptocurrencies and private equity. The first two, that is the AI ecosystem, which is investing and lending to each other and buying sales from each other, that ecosystem, and of course the private credit market, about which India knows so little about because it's rarely discussed. These are the 2 areas of maximum concern. Take the first one. Consider how incestuous relationships across the sector in artificial intelligence have pushed up valuation. Microsoft has invested at least $13 billion in OpenAI, which uses Microsoft's Azure cloud infrastructure. Thus, Microsoft is simultaneously an investor, infrastructure provider, platform host, and commercial partner, and potentially a competitor. Amazon has committed $8 billion to Anthropic, which uses Amazon's AWS cloud infrastructure. Amazon integrates or plans to integrate Anthropic's cloud models into its products, for example, Alexa. So Amazon is an investor, cloud host, partner, and user integrator of startup AI's models. Again, investor, supplier, customer, all rolled into one. Nvidia, the dominant AI hardware supplier, will invest up to $100 billion in OpenAI, which will also buy Nvidia systems. Nvidia has also invested in Elon Musk's AI startup, xAI, and will supply processors to xAI for data centers. The web of mutual dependence grows denser still. CoreWeave, a cloud infrastructure provider, is a major Nvidia customer, and Nvidia has guaranteed $6.3 billion to purchase of CoreWeave's unused capacity 2032. Nvidia's rival, Advanced Micro Devices, announced a supplier investment deal with OpenAI. Meanwhile, OpenAI itself has signed a 5-year, $300 billion contract with Oracle Cloud beginning 2027 and a separate 22.4 billion deal with CoreWeave, including 350 million in CoreWeave stock, meaning OpenAI is simultaneously customer, that is contracting for GPU infrastructure, investor, shareholder in infrastructure provider. CoreWeave also announced plans to work with Meta, creating further interdependencies. This is circular financing and inflates both revenues and valuations of the priciest part of the stock market. CoreWeave's valuation jumped from 19 billion to 23 billion in 2025, citing OpenAI contracts and Nvidia's backstop. Incredibly, companies are booking these deals as revenues and lifting their market valuation. Those multiples spill over and are used then in turn to justify higher values for other AI startups. Since there is no chance of the AI boom delivering profits on trillions of dollars of interlocking investments, it's a bubble that can burst. Torsten Slock of Apollo, a private investment firm, has noted that AI stocks are more richly valued than dotcom stocks in 1991. Then there is the private credit bubble. If that seems worrying, the parallel boom in non bank lending is as bad. Non bank private credit, that is lending by funds, insurers, and shadow financiers, especially in riskier mid sized firms, has ballooned to about 3.8 times GDP of Europe and about 3.1 times in America. Banks have lent around a tenth of their loan books to these intermediaries. The IMF reckons American and European banks have lent 4.5 trillion to private credit firms, hedge funds, and other non-bank lenders. A serious default could wipe out a chunk of the tier 1 capital, the capital cushion designed to absorb shocks. Yet the system, vast and opaque, sits largely beyond the regulator's reach. Their rise was accelerated by the very regulations, Basel capital rules designed to curb banking risk. Fintechs, hedge funds, and insurers now lend directly to riskier borrowers. Nearly half of American life insurance bond holdings are in private placements, invisible to markets and regulators. The system depends on faith, not transparency. Connected to speculative excesses in these two areas is irrational exuberance in private equity and crypto boom. Nobody knows what will spoil the party and when, but when it does, the scaffolding of credit and cross holdings may give way. And it will not stop at developed markets. The contagion will spread to emerging markets like India as investors sell indiscriminately to raise cash. If you are lucky, the dark clouds will lead to a few showers, not a hurricane. Those who have exposures to the market would do well to have their own risk mitigation measures in place. If you liked what you heard, please do share and do subscribe to this channel. Thanks for watching.